In this episode, we're going to show you one of the advanced ICT trading strategies. If that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel. So, before we get into the details of this strategy, you need to know the exact definition and application of these topics. We have fully explained most of them in the previous episodes, except the ABC pattern. If you are new to our channel, to fully understand these important topics, please go through our channel and watch our previous videos with the link in the description. Let's start with the ABC pattern. It is created by three major waves of price. It contains a rally wave upward, then we have a bearish retracement to the downside, and finally we have C wave to the upside. The C wave is a liquidity sweep that sweeps out the liquidity accumulated above the high. The B wave would contain a couple of candles, and doesn't have to be a significant downward wave. So this is the sort of pattern you should be looking for in a higher time frame. The key point is that a bearish ABC pattern is only valid when the C wave sweeps the liquidity above the highest point of the A wave, with only one candle or wick, and the second candle or a wick should not form or close upper than the first candle's body or wick. We want to see the price immediately changes the direction to the opposite side, and get back into the range below the high, after sweeping the liquidity. Let's move on to the next topic, market structure shift. Imagine a trending market with a series of higher highs and higher lows. In this case, each of the highs and lows are the market structure level, and the most recent higher high and higher low are the ones we monitor. Breaking the last higher high to the upward shows that price tends to go to the upside, which we consider as a break of structure. In contrast, if price breaks the higher low to the downside, it shows the price wants to change the primary direction, which we consider as a change of character. The key point is that a break of structure is valid even if a shadow breaks above the previous structure level, but for a change of character, we definitely need price to break and close the candle below the previous market structure level. Imagine we have a valid ABC pattern, that price swept the liquidity above the high, by the C wave with one rejection candle, and then reversed to the downside. The next step is waiting for a change of character to appear. So for that, if we zoom into the lower time frame, we would see a structure like this. As you can see here, in this scenario, the price swept the liquidity by this tiny wave. So if price breaks and closes the candle below the structure, then we have a valid change of character here. However, suppose price created a structure like this. In that case, this change of character is not valid because the structure, which is broken, does not belong to the wave that has swept liquidity, and was created after liquidity sweeping. So to have a valid change of character, price must break the structure which is made before liquidity sweep movement. Let's see another possible scenario. Suppose the price touches this high and gets reversed from it, without sweeping liquidity above the high. In following, price pushes upside and makes a higher high which sweeps the liquidity. In this case, we should wait for the first movement structure to be broken to have a valid change of character. Please note that we did not consider the upper
Recommended broker is Longhorn FX. It's an ECN broker dedicated to delivering a superior trading experience to traders.
Structure as the market structure shift. So let's get started on the following subject, fair value gaps. It is created by inefficiency in the market and usually occur in a specific zone, where there is less trading activity seen, and the price only has one directional movement. To identify a fair value gap, it's formed inside of three candle sequence, and it's the large candle, in which the upper and lower wick hits the neighbor candles and do not fully overlap its body. Let's get into the detail of the strategy. Our strategy has four major steps to follow. Step 1, we need to spot a valid ABC pattern in the 15-minute time frame. Step 2, we should zoom into the 1-minute time frame and look for a valid change of character. Step 3, we need to detect fair value gaps close to the current price of the market. Step 4, we should set up buy or sell orders in the entry points on the 1-minute time frame. As you can see here, we have a valid change of character in the 1-minute time frame. So, in the next step we should spot a fair value gap near the current price. So here, we have a valid fair value gap. In the next step we need to put our sell limit order at the lowest point of the fair value gap, and we should set our take profit at the lowest point of the B wave. And the stop loss must be a couple of pip above the fair value gap. Let's look at some real-time examples. So here, on this chart, we can easily spot A wave, and we have a B wave, then we have the C wave. Next, we draw a line from the highest point of the A wave. As you can see, price swept the liquidity by one candle's body or wick, and then closed below the line. Now we have a valid ABC pattern. In the next step, we are going to zoom into the 1-minute time frame and wait for a market structure shift to appear. As you can see, we have this market structure here, created before the market liquidity sweep. So we have a valid change of character or market structure shift. Now we are looking for the highest fair value gap to put our sell order. As you can see, this is the highest fair value gap, so we are going to set our sell order at the lowest point of the fair value gap, and place the stop loss a couple of pip above the fair value gap, and target the recent swing low on higher time frame. Let's see what will happen. As you can see, price pushed upside and activated our sell order. You can see price rapidly pushed to the downside and finally hit our take profit. Let's do another trading example. Here on this chart, this is the A wave, then we have a B wave, and also we have a C wave. The C wave sweeps the liquidity below the lowest point of the B wave with only one candle wick. And the second candle or a wick should not close lower than the first candle's body or wick. In the next step, we are going to zoom into the 1-minute time frame, so as you can see, we should wait for market structure shift or change of character to appear. So, as we have identified a valid market structure shift, or a change of character, in the next step, we should look for the lowest fair value gap near the current price. As you can see, we have a fair value gap right here, so we set up our entry order at the highest zone of the fair value gap, and also we put our stop loss a couple of pip below the fair value gap. And set our take profit at recent swing high on 15-minute time frame. We placed our order, and as you can see, our order is activated, the price rose and finally our take profit is hit. I hope this video was helpful to you. If you enjoyed the video and want us to keep making more videos week after week, please click the subscribe button and turn on the notification bell. And we'll see you in the next episode. Thank you for watching.